I'm Tyler Rudek, Chief Investment Officer at Boyum Wealth Architects. July was a reminder that markets can face several cross-currents at once. Questions around AI spending, higher treasury yields, renewed geopolitical tensions, and continued uncertainty around the Federal Reserve policy. This week, I'll walk through 3 charts that put those developments into perspective and highlight why maintaining a balanced and long-term portfolio remains so important. Chart 1 looks at sectors that compose the S&P 500. AI remains an important market theme, but July showed that investors are becoming more selective. Large technology companies are investing heavily in data centers and AI infrastructure, and markets are closely watching whether that spending will translate into durable profits. The chart shows that market leadership has broadened beyond technology. Energy, industrials, and other sectors have also performed well this year relative to the S&P 500. The takeaway is that long-term portfolios should not depend on a single theme. Diversification across sectors helps investors participate in broad economic growth while reducing the impact of volatility in any one area. Next, we look at global oil prices. Geopolitical tensions in the Middle East briefly pushed Brent crude above $100 per barrel in July, before it settled near $90 by month end. WTI closed near $85. The chart illustrates how quickly oil prices can respond to disruptions around key shipping routes and production regions. Those moves can affect fuel costs for households and operating costs for businesses. Higher energy prices can also complicate the inflation outlook. Still, short-term commodity swings are one reason a diversified portfolio should be designed to withstand a range of economic and market environments. And lastly, we look at interest rates and specifically the federal funds rate. At its July meeting, the Federal Reserve held the federal funds rate in a range of 3.5% to 3.75%. But the decision reflected meaningful disagreement within the committee. The chart provides important historical context. Rates are below the most recent cycle peak, but they remain well above the near zero environment that investors experienced for much of the period following the global financial crisis. With less certainty around future Fed policy, bond yields may remain volatile. At the same time, higher yields can improve the income and diversification role that high-quality bonds play within a long-term portfolio. And that is it for this week. The bottom line is that July's volatility was driven by several major themes, but none of them changes the value of a disciplined investment approach. AI investment, energy prices, and Federal Reserve policy will continue to influence markets, often in unpredictable ways. A thoughtfully constructed portfolio, balanced across sectors, asset classes, and time horizons remains the best way to stay focused on long-term financial goals. As always, please reach out if you have any questions, and thank you for watching.